Welcome to the Finance Podcast. The topic of this episode, Mortgages as an Asset Class by Matteo Bernardoni.
So, I propose we kick off. Thank you for joining, first of all, and a warm welcome from my side. I am Matteo Bernardoni. I've been working for UBS for the last 15 years, and I'm heading the Digital Platforms and Marketplaces department, which is a bit cryptical in terms of what we do, but it's especially about alternative investment into private debt or mortgages specifically. It's a pleasure to have a short presentation with you, around 40 minutes overall. I will try to spare a couple of minutes, 10 minutes more about for a question at the end, but we're a small group, so just raise your hand if you have any question throughout the presentation. The presentation is supposed to be in a first part in general, mortgages as an asset class, and mortgage compared to other investment products that you might choose for your asset allocation, and then specifically to the product that UBS can offer to you in order to invest into this new asset class, not new asset class, but special asset class, alternative and very non-traditional with respect to the overall universe of the asset classes. So the first slide is with regard to the positioning of the asset class. So you see on the left-hand side the typical profile, risk-return profile of different asset classes, starting from govies, government bonds, up to real estates. Corporate bonds we have also on the graph, and where we do normally position mortgages as an asset class, it's within the fixed income space. So mortgages are traditionally considered as a fixed income instrument for the asset allocation, but they cannot be compared one-to-one to government or corporate bond. These are not traded bonds, so we think that is a special mortgage asset or a special asset class that has some similarities to other asset classes, but also big difference to other asset classes. In terms of the investment types, I'm going to go into details on that, but you can invest directly, so through a granting of mortgages directly from your institution, or indirectly we have also investment vehicles from UBS, but also from other providers, so that you can invest in a diversified portfolio into mortgages. The same applies to bonds and real estate. Of course, we can directly and indirectly invest into such instruments. What's interesting, and I would like to spend a couple of minutes afterwards, is the spread pickup. I will treat this point specifically on the next slide, but for the time being, we see a nice spread towards covered bond, and sometimes also, depending on the rating, on corporate bonds. Of course, real estate, because it's a direct investment into the asset class, whereas mortgages are an indirect investment into the asset class. Real estate, in general, they have higher returns, but also higher risk because you have the mark-to-market of the real estate. Now, with regard to the mark-to-markets, of course, bonds are very liquid, whereas mortgages and real estate is not that liquid as a traded instrument, but you have also ways, that's why we say low to medium, we have also ways to disinvest into mortgages. So throughout the lifetime of a financing, you can also disinvest from mortgages in certain ways. And last but not least, the accounting, that's pretty interesting for certain institutional investors. The accounting is mostly booked value or fair value. But the book value is also something which is interesting for some institutional investor, because it contributes to lower the volatility of, for instance, the balance sheet of one institution. If you can book a bond or book a mortgage at 100, then you can of course keep it until redemption. Until the lifetime of the transaction. That's a brief introduction, and let me perhaps ask in the room, who does have a mortgage already? Fantastic. And who is investing into mortgage? Interesting. So both potential prospects from my end, because as a platform, of course, we offer mortgage in terms of an investment, but also we grant mortgages to people or to institutions requesting a mortgage instrument. So I promised that I would go in details with regard to the returns of mortgages. And as you may have heard, during the negative interest rates environment in Switzerland, we were talking about the uptick in terms of returns of mortgages, and there was a big question mark whether this return would still apply in a normalized interest rate environment. Well, that's the case, because here you see on the left-hand side from 2013 the pickup versus government bonds, and that was quite stable prior to the negative interest rate environment, and during the negative interest rate environment, and after the negative interest rate environment. More or less 80 to 100 basis points, constantly providing to institutional clients from return uptick. You see here on this table, general summary with regard to the current spread we see on mortgages. Just keep in mind, these are first lien mortgages, so Erstrang Finanzierungen, really the prime side of the segment. If you go into the second lien mortgages, Nachrang Finanzierungen, Zweitrang Finanzierungen, then of course the return is much higher. But even though we focus on the prime part of this market, we see a nice pickup towards government bonds, Swiss covered bond, SPI index of between 55 and 165 basis point yearly. So for a pension fund, for an insurer, for a bank, these, in terms of the fixed income, in terms of diversification of fixed income, might be an alternative to look at in order to increase the return pickup if you compare that with comparable bonds. That's the return side. Of course, there is also a risk side. And with regard to the risk side, UBS just published very, very good analysis, at least in my opinion, with regard to the mortgage market in Switzerland. Does anybody know how big the mortgage market in Switzerland is? Wild guess. 10 trillion. Nice.
150 billion.
Huh?
Around 150 billion.
150 billion. That's 1.1 trillion Swiss francs. So thousands billion Swiss francs currently in the market. That's a huge market. That's almost as big as the German market, with more or less 10% of population. And this huge market, of course, pose some question marks in terms whether or not a land like or a country like Switzerland with 6 million people can bear such a huge amount of debt. Well, the study comes to the conclusion that, of course, we can. You see Switzerland also to this extent as a nice stability, because even though we have a high indebtedness of the person, and this as a reason, that's not a reason because people cannot pay back debt or cannot pay back mortgages, but in Switzerland you normally hold the mortgages out of tax reasons. So that's the reason why in Switzerland we do not pay back mortgages, which is sometimes a discussion with rating agencies that we have to really stress the fact that it's out of a financial perspective and not from a risk profile perspective. If we see what's the probability of default, that's very low in if compares with European countries. So at the lowest level currently in Switzerland, we do not have much of defaults. This holds true also for the debt service coverage ratio, Tragbarkeits der Hypotheken. That's very, very good in compared to other European country. And also something which is mitigating the huge debt amount is the lower ratio of mortgages with variable interest rate. Around 23% of mortgages are not fixed term mortgages, but are SARON mortgages, variable rate mortgages. Last but not least, the study comes to the conclusion that one factor also reducing the risk or as a mitigant for the risk of the mortgage market is the regulation we have in Switzerland. That's a pretty tough regulation we have in Switzerland. If you do not know the Swiss market, in order to calculate the debt service coverage ratio in Switzerland, every bank or every institution uses 5% interest rates in terms of an assumption, even though the interest rates are much lower in Switzerland, currently around 2% interest rate. But nevertheless, independently on the cycle, the banks are using 5% to calculate the debt service coverage ratio. So in a nutshell, very nice return, very nice risk profile, but that's not everything you can get from this asset class. Uptick in return, risk mitigation. Perhaps I can also mention that on average we have in Switzerland more or less 50 to 55% loan to value. So if you compare the 1,100 trillion that I mentioned before with 50% loan to value, it means that the value of the properties which are backing these loans is around 2.2 trillion Swiss francs in value. So there's a huge reserves in terms of mortgages in the case of defaults. In the case of defaults of the counterparties, you have again high security that you're going to get your money back. Fourthly, as I mentioned before, that's a fixed income instrument, so it generates income recurringly. Every quarter you get interest and amortization on the loans because, of course, these loans get amortized. Normally in Switzerland you amortize from a mandatory standpoint of view to 2/3 of the loan to value of the properties. But of course you can go down as low as you like. So you've got interest rate amortization coming to your cash flows and giving you the possibility also to pay, for instance, for pension funds, the destinataries of the pensions. So it's a nice instrument that generates return throughout the lifetime of the transaction. And last but not least, I mentioned before, the market size gives the possibility to the investor really to invest large amount of money, large amount of investment, and also to move the needle, if I can put it that way, in terms of sustainability. I don't know if you've seen it already, but do you know how large is the CO2 emission in percent of the overall CO2 emission from the real estate and construction segment? So if the overall emissions CO2 is 100%, how much does come from the real estate and construction?
You're not covering it anymore.
Oh, thank you. 30%. Very good. 30%. That's something which impressed me a lot. So 1/3 of the CO2 emission, they are coming from real estate and construction. So if through the investment we're doing in that area, we are promoting the sustainability, we can really move the needle. Be it by financing already sustainable real estate with certificate like Minergie, GEAC, and so on and so forth, or promoting renovation, sustainable renovation with our mortgages. Yeah.
You talked about the global size of the mortgage market, but what's the annual turnover in terms of, so you spoke about the global size of the mortgage market, but how big is the annual turnover of the mortgages every year?
That's a very good question. We calculate there more or less 150 to 200 billion Swiss francs. They are either renewed every year or prolonged every year. So you have a nice turnover of the mortgage market. So in general, 150 to 200 billion. Yeah. Just wait for the microphone so that...
Sure. You mentioned the cash flows, and here you also talk about the amortization. What is the structure? I mean, it's an open-ended fund, or is it a closed-end?
I'm going to come later to the possibility for the investment, but I'm going to take your question straight away. So you can think about it if you are investing directly into mortgages, so pension fund Bernardoni investing into mortgages, you get, of course, the cash flow that are coming from the notional amount. You can calculate, let's make an average, if you have a loan of 1 million, with the current rate environment, 2% is coming as a cash flow, as an interest rate, and then we calculate on average 1% of the face value or the nominal value in terms of amortization. So more or less 3% you get in terms of cash flow, two return and one really amortization. And with regard to the fund, let me please park the question and I'm going to come back to you in a second. Thank you. Any other question from the audience? If not, then I would just like, and that's a very good question you asked before with regard to the turnover. We saw in terms of the pension funds in Switzerland, what is the regulation of the pension funds, which is the OPP2 or BVV2 regulation in Switzerland. And in terms of the regulation, strictly speaking, pension funds can invest up to 50% into mortgages. That's crazy. Nobody's going to do that, of course, because it's too much of a concentration risk. But currently, pension funds are only invested at 2%, so 2% of the overall pension fund money is currently flowing into mortgages. And if we would go from 2% to 5%, which is still very low, it's 1/10 of what you could do from a regulatory standpoint of view, we would be talking about 30 billion Swiss francs, which could be easily absorbable by the new renovation or a new renewal and prolongation you have yearly in the market. And that's, I think, something to bear in mind, because mortgages is getting more and more traction from the pension funds and the institutional investor standpoint of view. Microphone? Sorry.
Very often I hear from international pension funds in Switzerland that they actually compare it to other mortgages in other countries, and then they are a bit reluctant. So, what are the specifics really to the Swiss? I think it's really different, right? So you cannot really compare. That's why we have our own quota. How can you really differentiate it to abroad?
Thanks for the question. I think from a comparison in terms of risk, the funny thing is, I think you can really easily say that the solidity of the Swiss market is there and is not something, I would say, debatable. I mean, you can debate on everything, but the solidity is really there. When we talk to international institutional investors, I think the issue they raise is in terms of the return, which is far less than what we see in the international market. And of course, in Switzerland, we have a big competition among banks, which leads to the fact that the yield are also compressed. So that's normally something we have been talking to institutional investor. Nevertheless, in the last months, I would say, we saw already a nice increase or nice widening of mortgage margins. Normally, when we were presenting this presentation as an asset class, we were talking about yield starting from 50 basis points, so very low. Whereas here we saw a widening of 25 basis points, which might help some international investor also to get in touch with this asset class. But normally, the discussion I was having with international investors were less on the risk perspective than on the return perspective. I don't know whether it covers.
They just compare it with loans, and I think then that maybe they go in the direction of ABS or something completely different, and they really don't understand the difference here. But yeah.
Yes, I agree. There is, other than in other European countries, there is no established RMBS ABS market, which is making the asset class, in my opinion, very interesting nowadays, because you got still this uptick in terms of the return, 1% more or less, because if you compare that with the residential mortgage-backed security market, then the yields are much lower. So currently, also the illiquidity of the asset class not packaged in an RMBS structure is giving the asset class also an uptick if you compare that with RMBS. Yeah. So even though that's a very, very old market, from this standpoint of view, from this point of view of as an investment, it's really in the early stage, and it's when exactly you can get perhaps yield uptick you won't be able to get in the future. Brilliant. This I covered. Now, with regard to your question, how you can invest into mortgages. Of course, as I said before, you've got the possibility to grant mortgages straight away with your balance sheet, and you can build up a distribution network in order to address clients, be it private person or corporates, to grant directly mortgages, and you can get the overall process in-house with your infrastructure, with your manpower, with your men or women power, and with your capabilities. Now, what we normally see in the market are two other ways you can invest into mortgages. The first one is through platforms. There are platforms in Switzerland, but also elsewhere, that give you the access to the mortgage market. So normally they grant you the access to the distribution network, to a distribution network of a partner or of the platform itself. And they cover also the servicing part, which is for mortgages which might be costly and cumbersome, because it goes from getting the cash flows, managing the certificates, the mortgage certificates, so that your loan is backed by something on paper, and so on and so forth. So the platform part gives you the possibility still to grant directly, not through a fund, as you were mentioning before, so directly granting the mortgages, but not having to take care of the distribution and of the servicing. That's the one big option. The second one is exactly as you were mentioning before, through funds, investment foundation, Anlagestiftungen, if you are pension funds, or funds if you are an insurer, a bank, and so on and so forth. And there you normally invest in a diversified portfolio, which is generating then interest and amortization. So normally it's a pass-through structure. The loans that are generating interest and amortization, they normally pay the return to the pension funds or the institutional investor invested it. UBS is offering you also these two channels to invest into platform. UBS launched a dedicated platform in 2016 called UBS Key4. And with this platform, you can access two types of mortgages in the Swiss market. The first one is income-producing real estate, called IPRE or IPRE, income-producing real estate Renditeliegenschaften. So you can think about it like multifamily homes, commercial buildings, the commercial real estate, as it is called in Europe. That's the first platform I'm going to talk in a second. And the second one is the self-occupied real estate platform. So there you can grant mortgages to flats, to single homes, like Ferienhäuser, holiday homes. Buy-to-let segment is also in here. So these are the two types we normally distinguish in the mortgage market that you can access to the platform. And the second, in terms of the fund, we launched in 2017 also a dedicated Anlagestiftung investment foundation available to all pension funds, which free you up from the burden of selecting mortgages, pricing mortgages, analyzing mortgages. That's done by a portfolio manager at UBS, and then it invests your money, your investment into the diversified portfolio and grant new mortgages as soon as they've got amortization or repayment from the existing portfolio. Of course, they have different cost structures. So you see here straight away, if we're talking about granting directly the mortgages on income-producing real estate or self-occupied real estate, we are around 10 to 15 basis points. Whereas if we are investing in a structured fund, you have a total expense ratio of 30 to 55 basis points, which costs, of course, more in order to cover all the value chain, which is covered by the portfolio manager of the Anlagestiftung. Brilliant. Let me quickly dig into the UBS Key4 mortgage platform. That's the first option I mentioned to you. Here, UBS matches or connect both borrowers on the one hand side and the investor on the other side in a very transparent way. So if you're looking for a mortgage privately, just give it a try. It's key4.ch. You can get straight through the journey really fix offers from the investors that are on the platform. So based on the LTV, loan to value, the affordability of your loan, where the building is currently sitting, and a couple of other parameters like the tenor of the wished mortgage, you can get sharp offers from our investors. Of course, on the journey you see online, you do not see who is the investor behind, because we want also to protect the identity of the investor. But as soon as you send all the documentation related to your mortgage, you get all the offers on the platform, so you can pick the ones that are covering best your needs. That's something also we do deliver to the borrowers or to the clients requesting a mortgage. The fact that they can pick the cheapest offer, but of course it does not have to be the case. If you have anything against pension fund Bernardoni, for instance, you can take the second cheapest on the platform. So it's very transparent who provided an offer and who did not provide an offer, and which condition. The second point, interesting especially for an investor, is that UBS is also part of the platform with its balance sheet. So UBS is providing mortgages through UBS Key4. So the investor are assured that for every loans that comes to the platform, also UBS is bidding for these loans. So we try to avoid the adverse selection, moral hazard kind of problematics that we might have in setting up such a portfolio, being ourselves as a bank. Secondly, from an investor standpoint of view, of course, the credit granting policies of UBS can grant, I'll make it as a metaphor, up to this level. On the platform, we do normally have some restriction. For instance, construction loans, we do not have on the platform, or normally exception to policies, we do not have on the platform. And starting from the platform eligibility criteria, the investor can restrict or can limit their appetite to a subsegment. So for instance, UBS is granting on income-producing real estate up to 75% LTV. The investor can well say, I'm going to go up to 60, or I'm just going to cover this region or these tenors. So it's very, very tailor-made for the needs of the investors. As I was saying before, the last thing to mention, also with regard to the platform, UBS Key4 covers all the value chain of the mortgages. So it's only the credit granting part, the analysis or the positioning of the investment profile of the investors that sits with the investor. The rest is covered by UBS. So starting from talking to the client, talking to the borrower, setting up the documentation, taking care of the mortgage certificate, the Schuldbriefe, and also throughout the lifetime of the transaction, that's all covered by UBS Key4. So it's also easier for the investor to provide these financings. I would like just to mention the difference between investment properties and residential property, income-producing real estate versus self-occupied real estate. As I was mentioning before, these are two different markets in Switzerland. So from the 1,100 billion I was mentioning before, you can roughly say, really roughly say, that investment property are more or less 1/3. There are no sharp definition, but we say 1/3 is covered by investment properties, whereas 2/3 is covered by self-occupied real estate or residential property. So that's the lion's share on the right-hand side of the slide. And here, the platform works that way. So we have a deal-by-deal analysis of the financing in scope. So if the client or if the investor would like to invest in investment properties, they do receive a dedicated dossier that they can analyze and make their mind with regard to the fact whether they want to grant a loan or not grant a loan. That's a deal-by-deal case and a deal-by-deal pricing. So you can say, I would like to grant Mr. Bernardoni 5 million for his multifamily home in Zurich with a price of 2%, for instance. Because, of course, here we've got larger ticket size in on average 3 to 5 millions, starting from 1 million up to 30, 40 millions that we have pro ticket. So there we want the investor also to see the dossier they are investing in. Whereas the second platform on residential properties, you can imagine flats, single family homes, and so on and so forth. The nominal amount is lower, 500,000, and we do not want to give the burden to the pension fund responsible or the insurer responsible to take care of the analysis of a small loan. So there we do normally have a mandate from the pension funds. The pension fund comes and say, I would like to invest 10 million, 20 million in these markets with these spreads. And then we have an automatic engine which is taking care of the matchmaking, the pricing engine, retrieval of the price, and it's automatically. Of course, the pension funds get a notification when they are closing the mortgage, at which rate, with which counterparty, with which tenor, and so on and so forth. Any question to the two markets? If that's not the case, then just a couple of examples I put on that slide. You see the self-occupied real estate platform. We brokered almost 1 billion Swiss francs. In the income-producing real estate, 3 billion Swiss francs we covered up to now. And you see the different sizes of the investments that run into this platform. So on the left-hand side, normally a smaller investment size like 500,000, 1 million, 352,000, with LTV ranging from, for instance, 19.3% up to 71.4%. So still low LTV. You have a nice reserve, nice buffer of potential real estate decline before you are in your investment. On the income-producing real estate side, whereas in the real estate side, we have larger investment, as I was saying to you, 1 to 30, 40 millions Swiss francs. Here, for instance, in Geneva, 21 millions at an LTV of 58%, with nice Baugenossenschaft in Geneva, with tenors ranging from 11 to 20 years mortgage. So here you see there is also the potential to really get longer duration for your asset class or your asset liability management. What we do provide on the platform are also pricing comparisons. So if you enter for the first time the mortgage market, or if you're not that familiar with the mortgage market, we do provide you with some analysis dependent on the cantons you would like to invest, dependent on the LTVs you would like to invest, so that you can really compare your pricing needs with the prices we see in the market. So these are reports and updates that we send recurrently to the investors. Last but not least, I think with UBS Key4, UBS decided to enter the platform market, Gesundheit, to enter the platform market a couple of years ago in 2017. That has been really a nice story that we could develop together with our borrowers on the one end, but also with our investors on the other hand. And what we tried to position the product is particularly with regard to the quality we deliver to investor. So as I said before, there is no loan going to the platform which does not fulfill the credit policies of UBS, and UBS bids on every loan which is on the platform. So that's, I think, a strong value proposition, at least from my end, to really stress the importance of high quality of the loans you can grant on the platform. And secondly, mortgages can be a cumbersome instrument to manage, and for that reason we would like to position UBS as a prime provider of such services, so that you can just focus on the investment profiles, you can just focus on your needs in terms of an ALM perspective, and do not have to think about where's the mortgage certificates, who is going to talk to Mr. Bernardoni who has a question with the loans, and so on and so forth. Last slide with regard to a couple of voices from the market. Retraite Populaire just published an article with regard to the attractiveness of mortgages in terms of the asset class for pension funds. Here, Migros Pensionskasse or Migros Pension Fund also stressed the importance of having really good partners on your side when you're entering this market, which is really, really low from a risk profile perspective, but you have also to have partners who are calculating the risk in a very good manner, which are providing really quality services to that. That's it from my end. I really thank you for the attention, and I'm really pleased if you have any question that you would like to ask, to take any question, please.
Do you still see the demand from institutional investors to invest into mortgages? As I have seen quite some institutional investors got rid of some properties on the one hand side, especially if they are not ESG conform or compatible. And on the other hand, is there like the mortgage market or allocation together with the real estate investments, aren't these from time to time kind of combined in the asset allocation? What is your perspective on?
That's a fantastic question. Perhaps I'm going to come back to the first slide I show. So we see still very much interest in mortgages overall in the institutional space, especially from pension funds. So even though we are now in a normalized interest rate scenario, there is still this pickup. And there is still this diversification that you can book that at nominal instead of having the market-to-market. This is still the case on the pension fund side. On the insurer side, there I really liked your question because the insurances, they have from an asset allocation perspective, SST2, Swiss Solvency Test 2, and they put mortgages and real estate together. So normally as an insurer, you can invest up to 25% in real estate, up to 25% in mortgages, but together they can only make 35%. That's what SST is telling us. So exactly to your question, what we saw is that sometimes insurer, they came to this cap because they've got, for instance, 25% real estate and 10% mortgages, so they struggle with the 35 rules, and we saw some insurers withdrawing from either real estate assets or mortgages out of this rule. But overall, we see much of an appetite, especially from pension funds. Does it cover your view, or do? Yeah. So you all learned the mic.
Just out of curiosity, because I mean, RMBS, MBS are very spread in all other like jurisdictions, countries, etc. Do you know actually why it hasn't been the case in Switzerland? Is it too small, the market, or what are the underlyings?
That's really a fantastic question. I do not have the answer. So we ask ourselves many times why there's no residential mortgage-backed security market in Switzerland. There is a covered bond market in Switzerland, of course. And from a size perspective, there's no problem because it's 1,100 billion Swiss francs you could create easily in residential mortgage-backed security market. I think up to now there hasn't been the need from banks to issue residential mortgage-backed security because they're well capitalized. They have sound founding sources. So that's the reason I gave why the Swiss market is not that developed yet. But to be frank with you, I don't have the answer to that question. I just can imagine that's something which traditionally developed. Perhaps the market very, very well established in terms of banks. There is a huge bank competition in the mortgage market. But to be frank, sometimes you have to admit I don't have the answer to that. Maybe someone from the audience has a hint. It might come perhaps now. Because we saw, especially from pension funds, the request was here. They discovered the asset class during the negative interest rate environment, and they're still admiring and appreciating this asset class. So
yeah, because I think there is the case on this one because of the capital requirement, and if you are in the IG bonds, this is very low.
Yeah,
and could be still very interesting.
Yeah, absolutely, I agree. Yeah. And maybe we're going to see also the wish of incumbents like banks to offload their balance sheet sometimes with some regulation, too big to fail, or other regulation. So there might be now the need on both sides, on the supply side and on the demand side. Any other question? So if that's not the case, then thank you very much. Thank you for your attention. Thank you for your participation. And have a nice Finanzmesse. Thank you.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.